Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted today to have with me Colin McLean, founder and CIO of SVM Asset Management, one of the most successful long-term active fund managers in the UK. Welcome, Colin.
Hey, hi, Paul. Thanks for having me on. Thank you.
Yeah, big congrats on the 30-year anniversary. What do you look for in sort of investments in terms of sort of your stock picking?
We're looking for exceptional businesses that often start off being medium-sized, mid-cap companies, but we want to see that they've got the potential for dominating their space and having something distinctive that gives them some organic growth. So we're looking for quite special companies in their own niche.
I mean, unique brand or IPR or sort of like differentiation.
Yes, it's usually in, as you say, the intellectual property, maybe less than a brand initially, but very often they have the ability to create a platform and expand, in a fairly exponential way, get a network effect as they grow. So we're looking for ones that have something that will end up being a much required service.
Yeah, and then just on that one, the platforms. I saw you say your fund bought into the sort of like the Hook Group, which was one of the sort of the most successful IPOs this year. I think I just saw that it sort of IPO'd at £5. It's now trading at about £6. And what was your sort of thesis behind that one?
Hook Group was a company that we'd followed for a while because it was owned, still is, by Merian Chrysalis, one of these technology crossover funds. We've had for clients an investment in that, along with others that are like it, like Draper Esprit and Augmentum Fintech. And that gave us something of a view on Hook Group before it listed. And we liken that, the potential for that platform effect, for having attracted a younger demographic that some of the legacy businesses can't get, and also for having demonstrated that it can grow in a space with its own brands and nutrition, and maybe translate that over into areas like cosmetics.
And what sort of like growth rates would you expect to organic? Is it sort of like low double digits, sort of 10% plus, in line with most of the online retailers?
Yes, I think that's what we're expecting in individual areas, but with the potential, to jump shift as it moves into other areas or perhaps attracts bigger customers. If for some of the bigger legacy groups, it can offer a complete service in terms of attracting younger consumers into it and then providing all the logistics, it will add value to some major, perhaps cosmetics or other groups.
And when you talk about sort of a platform play, I mean, we're looking at sort of like for the Hook Group, sort of like 45% gross margins. But the idea is any incremental turnover coming in will actually largely drop down to the bottom line, both in profit and in cash terms, because effectively you're running websites and you've already got the logistics, and therefore it's you just see a huge operating leverage as you go forward.
Yes, the attraction, it's quite difficult in a lot of these businesses to just look at traditional metrics or expect it to progress in an even way of declining, increasing earnings per share or, improving metrics in that way. It often comes in jumps as they move into a new area or get a big customer, move, maybe internationally into another market. So there's usually jump steps in the progress. And, if you have a platform like that, it's usually winner takes all. The leader gets better margins and starts to become the place to go.
And could Amazon ever offer those type of services, or is it just really quite niche and there's a strong brand at the front end that the young demographic? It's a bit like sort of ASOS and Boohoo, that they could buy the product in the normal big retailers on eBay, but they go to the sort of like their tried and trusted brand.
I think you're right about that. I think any retailer online has to think that Amazon can tackle them and compete with them. So you have to be alert to that. But I think in building up a brand and I think a customer demographic and younger people, it can perhaps get something that Amazon would find a bit harder to penetrate.
Yeah. One area that certainly Amazon has found difficult to penetrate is online grocery. And I noticed one of your longer term positions and one of the best winners actually across all the funds is Ocado. And I mean, in terms of sort of like, the value and the positioning, I mean, again, another very, very good platform stock. I did actually see the headline last week that the market cap has now exceeded Tesco's, which I think is about the same at about 20 billion. And it trades at sort of like 8 times sales, I think, at the moment. And what do you see as sort of like, in terms of sort of whether any good news is priced in, or how do you see that business going forward?
It certainly looks in the face of things for something that struggled for some years to attract investors. It's now in the FTSE 100, as you say.
You're right about that, yeah.
It's got big deals around the world with, not just Marks and Spencer's here, Kroger and others. I think, though, it's still seen by many investors as a food logistics business, and it's been seen for the potential to take that technology platform into other non-food areas and maybe into some new services. And also, it does have some other private equity interests in its satellite that I think may have value as well. So I think there's bits of its potential that are maybe not seen by investors at present.
Yeah, I did see, because it's won some quite good partners abroad, hasn't it? I mean, obviously it switched from the Morrisons to M&S in the UK, but it actually also has signed a deal, I think, to lift and shift the technology to the likes of Kroger in the States, which is a huge sort of grocery chain there.
Yes, I mean, the challenge will be in part execution of making all of those facilities work. But it's got a model where it's got major partners. They can help support the capital investment needed, and it's been able to scale up without drawing in huge amounts of capital.
I did see
businesses like Tesco's. It's quite difficult. You got a legacy business, and we're watching ones like Marks and Spencer, Tesco, and so on. Quite difficult to translate them.
Yeah, no, I did. I was actually looking at the Tesco multiple, and I think it's on about sort of like 0.3 of sales and is profitable, whereas Ocado is on about 8 times sales. So there's obviously a bit of a difference in growth. And I did see that Ocado has been a huge beneficiary of the COVID lockdowns. I think it was at the interims or something. I did see one of the numbers, and it's seen an increase in obviously sales by about 30% or something. And a lot of it is the size of the basket, people just buying more online in one big hit from the deliveries. So it should continue. I guess you might see some softening off next year if we do get a vaccine. But in the grand scale of things, I mean, how do you see it? There's been transformational changes with the sort of the COVID, and there's been sort of like transitory changes. And I think this is probably, online retail is probably transformational. We're not going back to where we were. It's been, I mean, I did see some crazy stats that it was about 10% of online deliveries or something like that before COVID, and now there's about 20% or double or something crazy.
Yeah. I mean, I think a lot of people have been forced to use online delivery that might have had a real barrier to taking it up before. So we've got a lot of people over that hurdle. Yeah. And I think also for an awful lot of supporting businesses, all these enterprise support services, what's happened is that businesses have realized that they can do more online. And what they now need to do is to make those services resilient, get good cybersecurity, invest in that. So a lot of the supporting businesses that help online activity, I think they're going to still do quite well after the lockdown ends.
Yeah. And when do you come to actually decide to sell a particular stock, which is obviously just as important as buying it? I mean, it isn't valuation. It's sort of like other matters, I guess, most of the time.
Yeah, no, I think you're right. I mean, valuation by itself is something that we're reasonably tolerant of, or maybe by traditional metrics, things can look expensive, and it's often right to hold on. But we like to see the companies often, and that's helpful now with Zoom, but we see them often with their updates, and really try and make sure their strategy is still online. And if something does change, we had, for example, in the past, Ted Baker was a stock that we had for a while, and when you get something that changes and so fundamentally, hits a founder and hits the brand, it's something that did mean that we sold out of that. So if there's a big failing with a company, or it moves in a different direction, or one part of our analysis just turns out to be wrong, then yeah, we do exit.
Yeah, I mean, certainly with regard to the world's biggest platform stock, Amazon, it's never looked cheap. And I remember when it got down to about $12 in 2003 after the dot-com crash, and people were saying that it's all going to go bust and stuff like that. And the last time I looked, I think it was $3,000 from 12. So if you'd have ever bought on valuation, you were always wrong with Amazon, because the price has just gone higher and higher and higher, which is really sort of, you know, the thesis of yours, run your winners in terms of the platform. One thing which was quite interesting, I did actually see again in the portfolio, online retail, was Boohoo. And obviously that's been through some quite sort of like tricky times in terms of the, you know, allegations in Leicester about sort of like sweatshop labour and stuff like that. And so you held through that, and rightly so, because it went down to, it touched £2, and I think it's over $3 or $3.50 now.
We are out of that one now.
Okay.
And we're particularly seeing some other online businesses that we are, and retailers that we're stepping up exposure to.
Yeah.
So there's some of the ones like AO World and.
Oh, interesting. Yeah. No, that's definitely cheap, and there's certainly, I think with AO World, I mean, they sell, just for every viewer, I mean, they basically sell white goods and small electrical items, I think, en masse in the UK. And they're trying to expand abroad, aren't they, I think, is the... Yeah. Well, and perform better, I think, with margins and stuff at home as well.
Yeah, no, I mean, we like that. And I think for anyone who has ordered those sort of goods online, and there's been a lot more investment by individuals in houses and gardens and well-being and all that sort of thing. Ordering white goods has a lot more anxiety given the size of that and getting delivery right. And so, you know, finding a company that really gives a lot of hand-holding and assurance round about that delivery, I think, you know, makes people feel it's a good experience. It's a difficult thing to get exactly right, but people have a different level of anxiety over a turning up.
Yeah, and also I think, you know, Amy talked about transformational and transitionary factors with COVID, and I think that, you know, work from home more is going to be more of transformational. People are going to be working more from home. I mean, I work permanently from home, and lots of people who work 5 days in the office are working mostly at home, or certainly will be there for 3 or 4 days, and therefore are beefing up what they have appliances wise. And I think the sort of like during April, I remember talking to these guys, and they didn't have any chest freezers, bread makers, or coffee machines left because everybody was ordering through them. And I think that's going to continue, actually, because they're not there to go down for their latte at Starbucks coming out of Houston. They're going to basically, if they're staying at home, they're going to buy a top-notch coffee making machine, I guess.
Yeah, well, I certainly.
Yeah, well, there you go.
That category too. Yeah.
And I must admit, the management team are good there. I think from what I say. And just looking down some of the other stocks. I mean, another one which was really caught my eye was interesting was AB Dynamics, and I thought this was just a bog standard automotive testing business, crash dummies and stuff like that. And it seems to be really into sort of like autonomous vehicles and driver assistance systems.
Yes, it's a business that was mid-cap. It's grown a bit now. Seen by many, as you say, crash test dummies and very traditional limited stuff. But the whole world of automated driving, and even not just that, but bringing in collision protection and the stuff that is built into a lot of cars now, it has progressed quite well with that. And it's got big partners like Mercedes, and that's being driven by safety. And so, you know, one part of that world is obviously what Elon Musk and Tesla talk about autonomous driving, but here and now, a lot more of it is just about collision safety in urban environments and deciding in cities, you know, how you're going to model a complex environment with prams and cyclists and pedestrians and what you do. And AB Dynamics has been developing a lot of skill in that area and quite a complex thing.
And being a long-term investor, what's sort of your average holding period? I mean, it sounds though they're pretty long, I guess. You just if you're prepared to run your winners, the ones which are successful, you stick with it and are prepared to take sort of like, you know, drawdowns in the down market. But you don't want to be selling anything with large, you know, addressable markets.
No, that's true. And it can be several years where we follow a company from a mid cap up to towards the FTSE or into a much larger size. Quite often, if the companies dominate their space, even if it's quite a narrow niche with a service that they're providing when they're at the smaller end of mid cap, they can quite often grow without huge capital investment, or perhaps by the time they're capitalized at a billion or so, they might have made most of that capex. So you can grow with those companies without necessarily having to invest lots more as they expand.
Yeah, and sort of like, going forward, I did look over the returns over the past sort of 20 years, and the sort of the flagship fund has delivered twice what the FTSE All Share have. So big congrats on that one. So like going forward, what sort of like returns or you anticipate going forward?
Well, thanks, and certainly, we can't project or promise anything at all. But I mean, one thing that I can say, and that certainly helps performance, is investors should look at how the mid 250 of mid cap stocks has performed relative to the FTSE 100 of big cap stocks, and that's been an outperformance by mid cap over 25 years. There's so if you're starting your investment search in that area, it does give you quite a tailwind. That's the area where growth is. Top end of the FTSE is the big cyclical disinflationary area where you get those big oil companies or some others that are struggling to
Yeah, I did notice you haven't got any major integrated oil majors into your portfolio. Another big omission actually is on the is in financials. I don't think you've got any financials, in fact. Certainly no mainstream banks. I guess you're quite negative on those guys.
We don't have mainstream banks. Occasionally, we certainly do own some other financial services companies. So there would be ones like AJ Bell or ones like that in there, but not the traditional banks. I think they're pretty challenged at present. I think in between the ones that are pressed by a flat yield curve, so they're not able to to trade much, and then there's others which really make their money from credit and from positive rates, and with rates maybe going negative, and credit is so hard to assess just now. You don't know who's going to be made unemployed, what the what the impact of furlough running off is, and so on.
Yeah,
I think that's quite hard. So either from the yield curve or from credit, I think the major traditional banks are pretty challenged at present.
Well, they're certainly priced to destruction. They're sort of trading at, I think it's 50% net tangible book, but it sounds as though you believe they're value traps rather than sort of like, value plays, I guess.
We do for the moment. I mean, I think investors need to think a bit about whether inflation will come back. There's categories of investments where some inflation will bail them out. Pockets of that just now, but I think we're still in a disinflationary environment globally.
Yeah, no, I would agree on the CPI. One area, though, I do see inflation is asset price, and that draws me to another area that actually seems to be fairly light in your portfolio. Again, probably because you believe it's sort of a value trap. Are the UK house builders, because they're trading at the moment at roughly around about 1.1 times tangible book, and house prices last month were up 5% according to Nationwide. And if you look at the movie out in the States, they've been up 10-15% since March. And it's sort of like what's happening is that people are sort of deciding to upgrade to a garden out of apartments, but also it's sort of like people are a bit worried about asset inflation and therefore buying a house. And people who are in work, frankly, their deposits have increased hugely, and mortgage availability is still low. So it's quite an interesting sort of bull and bear case on the house builders.
We don't own them at present. I wouldn't be bearish on them. You're quite right. Properties are selling, just now.
Edinburgh in particular.
Yeah, I know, indeed.
Yeah. Okay. And then I see, rather than being a value investor, I mean, you're very much a sort of like a GARP investor you seem to be, because you've basically got quite a lot of heavy technology, telecommunications, and IPR heavy industrials. Is that right?
Yeah. Yes. I mean, I think in each of the areas, on telecoms, I suppose we've got We've got GAMA, which is a very disruptive business. So I think in some of the more traditional areas, the stocks we've had are really disruptors that have got different business models. I think investors might consider at present some of the industrial materials and other areas that are seeing some bottlenecks and some potential for inflation. So we don't think it all has to be in technology. I think there's a lot of change coming to manufacturing with shorter supply lines and a lot better monitoring of processes now.
Yeah, well, I do see you've got sort of like Aviva, Blue Prism in there, Kainos, also Sirius Power and people like that, high IPR, high technology content.
Yes, I think Blue Prism and Aviva in particular are helping those manufacturing processes. So I think that's quite interesting.
Yeah. And any other areas to avoid at all, other than the ones which are growing? Is it sort of like, is it value traps to watch out? Obviously, the integrated oil majors are difficult because of ESG and the oil prices. Obviously, they've got too much supply in the ground. Banks are fairly much challenged in terms of credit cycle and the yield curve. Anything else you sort of like? I mean, I'm guessing you're probably going to say retail, traditional.
We don't have any traditional retailers at present. Hard to find winners there. I think, well, as I was going to say with one exception, and I think some companies are able to transform. The one exception we have there is Next, which is gradually closing down some high street sites. It's always had catalog business, which is translated quite well into online, and it's something of a platform that other retailers use as well. So that's a bricks and mortar, moving through onto. Yeah,
and it's got one of the best management teams I think in retail, hasn't it? It's been able to change with the times, which is done really well. What else do we have here? Just on the sort of like globally, so what sort of like macro downside risk do you see going forward? I mean, is it just something we can trade through, or is it really sort of, presidential elections? We've got sort of like, potential Brexit and all that kind of stuff. Anything to sort of like to watch out for?
I think probably people are paying more attention now to the US election. I think not so much just the outcome of the election, but the period in which the outcome may not be clear. I think so. I think the dollar has been quite weak. There's potential for quite a bit of uncertainty there until the results accepted, and I think that's something that should be a focus for investors. Until then, maybe the euro will be a bit more of a safe haven. Yeah. But we don't see particular concerns in the global economy. Yeah, general shortening of manufacturing supply lines following this, and more resilience will matter. But I think a lot of the world economy I think will recover quite well. Yeah,
no, I'm optimistic for 2021 as well. One thing which did caught my eye in terms of portfolio construction was that you do use derivatives contracts for difference, and given you have a very long-term time horizon, I was surprised you use that, because you probably hedge your position using just straight natural time that you can wait it out. But you've obviously decided that you're going to use some CDFs as well.
Yes, they're generally not. We don't have short positions in the fund. We're generally not hedging in that way. We do find some flexibility. Using those contracts for differences helps manage some of if there's inflows and outflows in the fund.
It's a technical thing.
Core portfolio. So I would say we're not trying to do anything clever with that, but it helps manage some of the flows.
Okay, well, brilliant, Colin. Thanks very much for your time. And if investors ever want to sort of put some money into the fund, where's the best place that they can contact you? Or is it just the website or email or whatever?
Website. All our details are there, so that's probably the best place to start.
Okay. Well, thanks very much, Colin. I appreciate the time.
Thank you.